Welcome to the Rose Show podcast. Thank you, everyone, for joining us today. I'm here with one of my favorite global economists, Daniel Lacalle. You're amazing, Daniel. I love your work. Thank you so much for speaking with me today. I'm truly honored. So how are you?
I'm very well. Thank you very much for having me. It is truly a pleasure because I also follow your work and I find it fascinating. So thank you so much for inviting me.
Thank you. Daniel, your YouTube channel has been one of my top watches. We are bombarded with so much information nowadays. And with our bandwidth constraint, we have to be highly selective. And your economic information is always very concise, to the point, and completely in line with my thinking. So could you please tell our audience a little bit about yourself?
Okay, I'm a PhD economist. I'm also a professor of global economy in IE Business School, and I'm an author. I've written 4 books in English: Freedom or Equality, Life in the Financial Markets, The Energy World is Flat, and Escape from the Central Bank Trap. And I'm also a fund manager, so a little bit of macro and a little bit of markets.
A little bit of everything. Thank you. So I'd like to begin with the elephant in the room, inflation. Persistent, elevated, rising core inflation is our greatest challenge globally. As you have said, and I completely agree, we have low growth, more debt, higher deficit spending, less liquidity, rising rates that will raise the cost of this debt, and high core inflation that is still rising and is cumulative. So why the risk on appetite?
Well, the risk on appetite comes fundamentally from a perception that the worst on inflation is over. And you've just said it, inflation is accumulative. So the fact, I always make the analogy that if I gained £6 last year and I add another £5 this year, I'm not getting any thinner. No? This is the problem of the narrative, is that as we saw in August 2022, markets get used to the view that the worst in inflation is over, and then expect that after that, central banks will start cutting rates. Therefore, the level of liquidity comes back into the market, and the risk on appetite adds to that environment. So it's basically a monetary phenomenon. Is assuming that central banks are going to U-turn on their policy, are going to pivot, as they say these days, and that's a very dangerous narrative. And it's a very dangerous narrative for a very simple reason: is that for once, everybody should actually do what they always said that you should do, which is not fight the Fed. If the Fed is telling you that they're going to hike rates and that they will persist with higher rates for a prolonged period of time until inflation has come down to 2% or lower, then one should not be betting on the opposite. And I think that is the big risk, no? That most markets are assuming that the worst in terms of monetary tightening and the worst in terms of inflation is over. And we have the Chinese reopening. We have, obviously, as you very well mentioned, very elevated core inflation. Core inflation is rising now.
Absolutely. Thank you so much for that. Now we see services and wages are very sticky with a tight labor market. And the market seems to be pricing in a deceleration to continue. And that was mostly due to commodity energy and durable goods, used cars. Now, it can only go so much lower. Do you think that at some point this year, we will have that rude awakening that inflation will remain sticky in a higher range than that 2.5% or 2% that the market seems to be pricing in right now?
I certainly believe so. First, because you've very well mentioned commodities. No, last year we saw that level of inflation, the headline inflation, was coming down because of one particular factor, which was the shutdown of the Chinese economy, and that obviously being the largest importer of oil, natural gas, coal, copper, and other commodities certainly has a massive impact. And we saw commodities in general descending basically to pre-Ukraine invasion levels. However, the reopening of China creates the opposite effect, doesn't it? So that's one thing to be concerned about. And you've just mentioned two very important factors, is that the tight labor market plus wage increases that we have seen throughout 2022, even if the wage increases have been below inflation, they certainly create a second derivative effect on inflation that we should at least monitor. So I'm concerned about market analysts saying things like, if you deduct the prices that go up, prices are coming down, which is fascinating to me. But what I find very, very worrying is to believe, when we have the evidence that it takes at least a decade to bring inflation down in developed economies once inflation has reached higher than 5% levels, I find it very worrying that markets seem to be discounting that everything will be over by July, August 2023.
I agree. I believe Deutsche Bank said that once inflation is over 5%, it could take up to a decade to go back to 2%. Does the market not know these important details? And you did mention the second order consequences, and that is very, very true. My next question is actually about inflation versus the recession. Now, Europe has been in stagnation since before COVID. And I heard that actually on your YouTube. And they may escape a recession now, but not inflation and stagnation. But it appears the market seems to be cheering that they can have a soft landing and have lower inflation. But that certainly does not seem to be the case, as it's either, in my opinion, it's if you have inflation come down, then the recession will be quite severe.
Exactly. And the only way to curb inflation is by weakening aggregate demand. Huh? And if aggregate demand comes down, when 50% of that aggregate demand, which is government spending, it's about 50% of GDP in European economies, even 60 in some cases, is not coming down. So if government spending is not coming down and you expect aggregate demand to be lower, then you're basically, in fact, betting on not a recession, but a deep contraction of the private sector. And there's no other way of really curbing inflation. So it seems to me, you just asked the question, are people not paying attention to history? Well, they're not, certainly. A lot of the narrative comes from this time is different territory. No? There's a book behind me by Ken Rogoff and Carmen Reinhardt called This Time is Different, which shows that no, this time is not different. But we tend to repeat that. Oh, no, this time will be different. We will bring down inflation very quickly, but it will not affect aggregate demand, and we will avoid a recession. And the point is the following: is yes, it's true that the European Union may avoid a recession, but why will it avoid a recession? Well, just looking, not now because it's very, very dark, but if you look out the window, what you will see is that it's a very mild winter. It should be snowing right now. It's a very mild winter that has certainly made energy prices and gas prices, natural gas prices in particular, and obviously demand be weaker. And that certainly helps the European Union, which is a very large importer of commodities. No, so if GDP is government spending plus consumer spending plus investments plus exports minus imports. If imports are lower, it certainly allows the Eurozone to escape recession. But that is basically it. It's a mild winter. So to have a bullish view about the European economy, and certainly not just a bullish view, but markets are soaring in Europe in the most cyclical stocks, no? To have that bullish view simply because it's been a mild winter it's actually pretty scary, to be fairly honest. If we look at the latest PMI figures from SP Global, most of the European Union remains in contraction. Manufacturing sector remains in contraction. So I would be prudent. At least I can understand that valuations could have changed to a level that were attractive in some cases, but not to generate such an aggressive move or such an aggressive bounce in January.
Agree. Thank you so much. Maybe this winter is different than last winter, but that seems about it. And we're also experiencing.
I heard from a utility CEO on Saturday, actually, that he said to me, "I'm not worried about winter. I'm worried about summer." Because everybody's talking about winter and you have elevated levels of natural gas inventories and you have a mild winter, etc. But if you have a mild winter and summer is very hot, demand for air conditioning and demand for natural gas is going to soar. So that's the challenge.
Absolutely. We always need to think ahead, especially for what's to come next. And speaking of what's coming next, is this recalculation of CPI. It seems that they don't like the readings, so let's find a new way of coming up with a number. What are your thoughts on that and its potential effects on the inflation readings going forward?
Oh, that's the oldest trick in the book, isn't it? It has been happening for decades that statistical bodies tweak the formula and the basket in which they calculate CPI in order to make it less negative, and that has been happening for decades. In fact, CPI itself, the CPI basket, was created by a well-known economist, Irving Fisher, in the United States, who lost a lot of money in Wall Street because he suddenly saw headlines saying bread is up 50%, and he got very angry. So he basically said, let's put bread with things that go down so that the 50% increase in bread plus the other elements in the basket don't sound so aggressive. No, I'm joking. But CPI basket is not a good measure of inflation to start with, because the basket of the poorer citizens has a higher weight of energy and food, and therefore it's much higher than the official CPI. And obviously, because, for example, if you look at CPI, the things that we purchase on a daily basis go up, and things that we purchase very occasionally actually go down. For example, technology or leisure. How many times do you go on holiday a year? How many times do you purchase a computer like this one? Once, no? But if you have food, energy, clothing, shelter, and technology, which you purchase once a year, bringing down the CPI basket, then obviously there is a little bit of a trick, no? So yes, I mean it's always going to happen, and it is happening. No, in Europe, you're seeing it, for example, how rents and how the energy component of the electricity part are being tweaked by governments. So that's what they're trying to do, and they will do it, by the way, which in any case doesn't change the perception of citizens. Citizens see what they're spending, and they know that their cost of living and that the purchasing power of their salary is worsening. No?
Yes, absolutely. Thank you so much for that. Yeah, the perceived versus the actual, and people know that costs are still elevated and actually rising. We noticed that with our manufacturing business. Cost of goods sold and operating expenses are still rising, and they're new fees. They're disguised. It's like all an illusion. Oh, a CPI is coming down and now they're going to recalculate it differently. And I think people know, and I appreciate, Daniel, how you take complex economic theory and you make it so relatable for everyone. So I love your examples. Excellent. The bread example, that was all of it is great. So thank you.
Thank you so much.
I want to ask you about the inverted yield curve. It's like nowadays, everyone's an economist, it seems. Everyone's talking about this inverted yield curve. Could you please bring a little of your knowledge to that yield curve? Is it really, truly a predictor that we are going to have a recession? What is it really telling us?
Okay, historically, an inverted yield curve used to be a good bellwether of recession for a very simple reason. If the yield of a 2-year bond, for example, is higher than the yield that the market is expecting for a 5 or a 10-year bond, what it's basically telling you is that it's expecting deflation happening, and therefore that means that at some point people are expecting a very abrupt recession. Huh? And people tend to look at different yield curves, 2 to 5, 2 to 10. All of this looks very technical, but it basically means that if you think that the price of something today is more expensive than the price of something in 5 years, is because you expect that in 5 years the economy is going to be worse. That is basically what it means. However, since the beginning of the crazy, excuse me, since the beginning of the crazy monetary policy of central banks, yield curves are not so good at predicting recessions for a very simple reason. It may discount a recession, or it may discount simply that central banks are going to continue to be extremely accommodative. Doesn't necessarily mean that there's a recession. It means that the economy is weaker, that's for sure, but not necessarily a recession. And also, remember what we said before about GDP. Recession means 2 quarters of contraction of GDP. But GDP, if you bloat government spending and you import less, for example, you may not have a recession, yet the economy is worse. No? And that is something that is, for example, very typical of economies in which government spending is very large and deficit spending is very large. So if you think about it, in the United States, if the administration is going to increase the deficit by $1 trillion, okay, the services and the manufacturing sector may contract by $500 billion, which is enormous, and still not have a recession in official terms. So I prefer to look at more things than GDP. Yeah? But the yield curve right now, it doesn't seem to be more predictive about a recession for a very simple reason, is that all of the different yield curves are all inverted. Sometimes you have one, two that are inverted, but when you have an entire curve inverted, it is certainly saying that nobody in the bond market truly believes in the concept of a small slowdown or a soft landing, as they call it, or low growth, but an actual prolonged contraction of the economy.
Very nice, thank you. Now, we've talked about this before, stagflation. Yeah. In my opinion, stagflation is looking even more likely. What are your thoughts regarding stagflation in the near future, maybe later this year into next year? And are you seeing signs of that? And what are those signs, please?
Well, the first evident sign of stagflation is the fact that core CPI, core inflation, that is inflation excluding the volatile components of food and energy, is rising while the economy is slowing down and quite rapidly. You know? And if you look at, for example, in the United States, you see how the whole new home sales, existing home sales, how consumer confidence, different leading indicators are getting worse. Yet core CPI is rising and remains elevated. Then that is certainly a signal of stagflation. The problem with stagflation is that usually, and we remember the 70s, for example, even when you are in stagflation, the mainstream economists tend to say that you're not. No? Remember that even in 2008, about 50% of mainstream economists said that there was no crisis yet. No? So it's one of the problems of stagflation is that the Keynesian view is that stagflation is not actually a problem, because as long as there is some inflation and the economy is not collapsing, then everything is fine. But as so many citizens in Europe will attest, that is actually the opposite. It's much worse, because a recession is something that can heal quickly. No? Even a depression is a way of cleaning up the system very quickly. And but stagflation is like slow death. No, it's like walking zombie.
Yes, it is. In your opinion, this will take time. Do you have an idea of how long this process could take this time around? What are your thoughts?
I think that is the $1 million question, no? And probably $1 million in current dollars, not in future dollars.
Actual dollars, yes, real dollars.
So I really don't know. And the reason why I don't know is because a lot of the rules of the book have been, let's say, forgotten or at least subverted. No? In the case of a situation like the one we are in today, you would imagine that central banks would be implementing rates that would be closer to 5 to 6%, not 3 to 5%. Okay. The second is obviously that central banks right now would be contracting their balance sheet, and that's something that is yet to happen. No, so that may be a signal that things may last more than what we expected. But there's also a deflationary effect that is very, very evident, which is, well, two. No, one is technology. Hugely deflationary, and the other one is globalization. So right now, globalization is under threat because a lot of countries are talking about reshoring and all those things, which sound very nice until you actually implement them and you start spending too much money on goods and services. But so my view is, in a nutshell, that the way that it looks is that it will take at least until 2025 for inflation to come down to levels that we would consider acceptable, which is about 2%, which means that if you put the accumulated inflation in 2021 to 2025, it will be about 20%.
Agree. Thank you so much. I was thinking 2025 as well, but that makes a lot of sense. And thank you for putting that in that context. I'd like to ask you about the slowed growth and GDP. You made an excellent point and about debt to GDP and how people are sort of confusing how we have, well, in the US, we have estimates for Q4 at about 3.6%, I think, real GDP. I think the Atlanta came out with that. But we have high debt. And this debt is now going to be with higher costs because of the higher rates. So inflation works both ways. And when it comes to earnings, I always say, yeah, you have higher expenses, but you also have higher revenues due to inflation, not necessarily higher output and volume. So the same thing works with GDP and debt. And could you explain what's going on and these misconceptions that some people are just not understanding regarding that, please?
Yeah, to start with, many people say inflation is good because it's a way of reducing debt slowly without hurting the economy. Well, first, it doesn't happen. No, we've had inflation at different levels, and debt just continues to balloon. No, and even in countries that have monster levels of inflation, the levels of foreign debt and the levels of indebtedness don't fall. And the reason why they don't fall is very simple, is that when inflation creeps up, governments spend alongside inflation. So the government program that was at €1 or $1, if inflation is 10%, rises to 1.1. No, they spend more, yet the economy does not have that that optionality is margins in companies get weaker, families have less purchasing power. So that's why debt actually does not just not go down, but it goes up. No? The other element is that the structural problem of debt in most developed economies, and it's certainly the biggest problem in the United States, is mandatory spending. And mandatory spending tends to be adjusted with inflation every time that inflation rises. So that's why there is a double-edged sword of inflation on that front. The government, on the one hand, collects more receipts because it doesn't reduce taxes with inflation, which it should. It should actually put those taxes, deflate those taxes with inflation. Actually, in the United States, it does, but it uses a deflator that is different than CPI, so there's always a catch. No? So what happens is that the government gets used to higher revenues, higher receipts in a period of inflation, increases spending to curb inflation. All these anti-inflation programs, they're inflationary. They're paid with inexistent dollars. So the wheel of debt does not stop. It actually continues to go, and it actually goes faster. So it's the only way in which you can control debt is by reducing spending. The only way. Yeah, any company knows that. Any family knows that. If I said to my family, "Hey, we're going to reduce debt, spending more," I would be thrown out of my own home. What the hell are you talking about? Are you stupid? Yeah. The only one that says that we're going to reduce debt, spending more, is the government, because it's catering to the first recipients of that money, to the ones that receive those entitlement spending or deficit spending first.
Absolutely. Thank you so much. So at some point, we have to wonder if there's so much spending going on and they're not changing what they're doing. And they keep talking about all this tightening that we are doing and we're supposed to be doing. It's this whole mirage. What can happen? Can something break? Will something break at some point to stop this pattern that's going on?
Yeah, at some point, I think that everybody, it's like, think about this. I'm going to use an alcoholic analogy.
I love your analogies.
Everybody starts drinking, and everybody says, "Hey, I'm fine. I don't have any problem. I can drive. I can do all sorts of things because I believe that I'm fine." But obviously, you're poisoning. On the one hand, you're poisoning your body, and on the other hand, you're putting at risk others. And that is what debt is. Debt is literally something that you don't perceive as going to generate a problem until it happens. So when does one find out that they actually had drunk too much? When they have an accident? No, when they have a heart attack. That is, and that works exactly the same way. So it's a fallacy to think that we will be sort of warned in advance. Usually what happens is what we're seeing right now, is that government spends more, increases deficit spending, raises the debt ceiling, nothing happens. It's great. Let's do more. Let's do more. Let's do more until you crash. And you don't find out until you crash. The problem is that it's incredibly difficult to predict when you will crash. We had some warning sign. We had a heart attack moment last year in Japan when Japan's currency suddenly collapsed because of the increase in these imbalances. The UK, which is also monetary sovereign, also had a similar situation. The government announced, thinking that nothing would happen, a budget that would massively increase its spending and massively reduce taxes, and they had a huge, warning sign. So what did both decide to do? Nothing. And that is the problem of debt, is that it disguises risk. But exactly. We don't know when it will happen. We know it will happen. We know it will happen. Yeah.
That's it. Thank you so much. Makes a lot of sense. And you say the word taxes, and you make a great point how our taxes will be increasing
Yeah.
and it will hurt the middle class. Could you please tell us a little bit more about that?
The middle class and the voter is always fooled by the message that we're only going to increase taxes on the wealthy, and you're not going to suffer any of it. So don't worry, we're going to spend a lot more, and the wealthy are going to pay all of it, which makes absolutely no mathematical or statistical sense, because the wealthy, first, are very few. Second, they have most of their wealth in shares, not in not in a sort of fortress like Uncle Scrooge, and they are also hugely indebted. So the idea that you're going to massively increase imbalances and increase the deficit spending, and that all of that will be paid by 0.1% of the population, makes no sense, or 0.1% of corporates for that matter, makes no sense, and it makes absolutely no mathematical sense. The only way to convince you is, one, to say we're going to increase taxes only on the wealthy, then you increase spending. The revenues that you get out of those tax increases are much lower than the increase in spending. And then, obviously, use politics again, and say, the evil rich did not pay enough, so we're going to increase taxes on you. And then you say, it was the evil rich.
Yes, it was.
But it's very simple. Ultimately, taxation is very simple. Any government knows that the highest level of collection of receipts will come from the largest number of taxpayers, and the ones that are, I call them hostage taxpayers. That means that you have a salary and you cannot escape. So, that is the bulk of where you're going to collect taxes. And that is always the bulk of where you're going to collect taxes. It doesn't matter if it's the Republicans, the Democrats, or some new party you want to invent. The reality is that every time that somebody tells you we're going to spend $1 trillion and only 1% of the population is going to pay for it, you will pay for it.
Exactly. I love that. You bring the truth to the people, and I love that. It's a democratization of macroeconomics. You're dispelling the myths, and I appreciate that so much. It's important that people are aware, and awareness is key to know what's really going on in the world. And that is, thank you for explaining that. It makes perfect sense. I want to move on to the dollar. We've seen some recent dollar weakness, but I don't believe it's going to last for long. And you make a great point. I mean, apparently it's about supply and demand, and the demand is increasing for the dollar, and it seems likely to continue. Could you please explain that and how it's a bellwether for risk, and this risk demand is rising?
Yeah, risk demand tends to rise when the dollar is weaker, fundamentally, because if you think about the market is very complex, but at the same time, it's very simple. It is a huge bet against the US dollar. When you purchase stocks, bonds, and emerging economy stocks or European stocks, whatever you want, you're basically taking a bet against the US dollar. And what happens is the following, is that in periods of monetary expansion, all central banks all over the world believe that they can increase their imbalances and increase money supply massively without any problem, and that will be absorbed by higher risk demand. And from time to time, Federal Reserve starts to hike rates because of internal problems in the United States. And what happens is that it literally shows that the tide turns, tide comes back. Tide comes back. And what happens literally is that that carry trade, that negative bet on the US dollar, if it's not fundamented by increase of demand of the emerging economy currencies, etc., or European currencies, whatever it is, then it comes back massively with a reduction in risk. No? So imagine you're the central bank of Colombia or of, I don't know, Vietnam, I don't care. You start increasing money supply, and you believe that the demand for the local currency is going to rise with it. But in fact, what is happening is that demand internally and externally for debt of Vietnam or Colombia in local currency is diminishing, and demand for those countries' debt in dollars is rising. Therefore, the future demand for dollars is rising. You're going to have more dollars in the future in order to repay the debt that you're issuing in what we call in the market hard currency, which is US dollars. So the amount of debt issued in US dollars rises, the demand of the local currency diminishes because citizens don't like the loss of purchasing power of their local currency. We complain about the US dollar or the euro, but think about Argentina or Turkey. And then at a certain point, what happens is that the demand for the local currency has fallen while the demand for dollars has risen because of the amount of debt issued in US dollar. So that difference means that the world requires more dollars and that the Federal Reserve does not necessarily supply them. So, and everybody can say that this is an evil conspiracy, whatever. But the reality is that there is no alternative to the US dollar, because if every time that there's somebody talking about monetary policy, everybody in every central bank is copying the mistakes of the Federal Reserve, but none of the things that they do properly, then obviously there is no alternative globally to the US dollar.
Yes, thank you. It makes a lot of sense. So do you think we may see newer highs on the dollar anytime soon?
To start with, we will likely see relative highs against the major major currencies with which the US dollar trades. That is an important one. The differences between the US dollar and the euro basically fluctuate. But if you look at the euro dollar, the long-term trend is unmistakable. It's gone from 1.4, 1.3, 1.2, 1.1. So it just goes down.
Yeah, downtrend.
So I think that we will, and I think that we will because the currencies that actually could have been a contender for the US dollar, which were the yuan and the euro, have made huge mistakes. The European Central Bank is caught between a rock and a hard place. It cannot stop the massive amounts of increasing in money supply, and continues. In fact, it continues with its programs of repurchases, etc. And the yuan has capital controls. You cannot be a world reserve currency with capital controls. So I find it difficult. So we may have fluctuations, but I think that the trend for the US dollar is likely to remain strong, not necessarily rising, but strong. Between the DXY, the index of the US dollar, it always sort of moves between 99 and 105, 110. That's what it's going to be. That's what, by the way, when it gets too high, the Federal Reserve starts to be a little bit more dovish. So they're also not trying to have a very strong currency.
Exactly. Thank you. Absolutely. The currency doesn't exist in a vacuum. It's always in comparison to others. And great point that you make. The two contenders that add the greatest threat to the dollar, euro and the yuan, both are suffering. So seems the dollar will continue its path. I'd like to transition over to earnings. Earnings, my favorite topic. being in financials and my entire career as an entrepreneur and executive officer, CFO, CIO, currently CEO, financial statements. I enjoy math. Let's just say that. So, we've had compressed margins for quite some time. And not only higher and rising cost of goods sold and expenses, like I said earlier, but also revenues are held up more so by inflation than higher output and volume. So I'd like to know your thoughts. I know that we both agree on this one. They seem to lower expectations before earnings come out. They come out and somehow they miraculously beat. So it actually makes everything look better, but it's much worse. Do you think we will have an earnings recession, or do you think it'll be averted for now because of this illusion that they may create for us?
No, I think we'll have an earnings recession because, I mean, you come back from the reality. You come back with a very high experience in the reality of business, and you know that in business, once you have started a trend in which margin compression is a challenge and you need to maintain the business working, and at the same time working capital is more expensive because interest rates are rising, you may have acceptable earnings to survive, but you're not going to have rising earnings. No? So it is virtually impossible to see an environment in which the earnings growth matches analyst expectations, particularly for 2024, in the current environment of both rising rates and compression of margins. And margin expansion doesn't happen in periods of low growth. Remember that, again, your experience is very useful here, because when you have rising rates, you start to get into an economic contraction. But when the central bank decides to pivot and start to reduce rates, is because the contraction is already evident everywhere, not because things are great. No. So the mistake that I think that many people are making is to believe that a rate cut in the second part of this year, which I believe will not happen, but in any case, if it would, it's not good news. It's not good news. If that happened, it means that the contraction is extremely severe. So think about this: whether there is a rate cut or not, the risk of an earnings recession is very high. Because yes, you mentioned the typical action of market analysts, which is massaging consensus. No, you basically you bring down your estimates a little bit too much. No? Then the company gives very bad earnings, but they're better, and you always have 80% beats in the S&P 500. It's beautiful. No?
I know.
But the reality is that the trend. So, and then you change that. You start the trend again. You start downgrading earnings into the third and the fourth quarter. I just don't see how you can expect higher earnings in this macroeconomic environment and monetary environment that we think of. So I think that it's almost inevitable.
Agree completely. It's so wonderful to hear you say that, because I've been saying this, and there's been a lot of criticism against that. And I look at the numbers and I see we have rises in cost of debt, capital, production, labor, also reduced productivity, which is very important. And I'd like to talk a little bit about that. Challenges bring forth opportunities. And I lived through 2000, 2008 in the business world, and we seize those opportunities. And it's important to remain liquid during this time and to seize those opportunities. And at the same time, lowered productivity, that challenge in itself provides opportunities. There are a lot of emerging leaders, industries from that. And we see autonomous equipment is one of them. It's been proven in research, and in our manufacturing business, we are implementing AI as well, and it helps increase productivity. What are you looking at in particular when you analyze investments for opportunities during this time period?
Yeah, what we tend to look for is companies in which we don't have to make a massive bet on the cycle. So we don't have to make in which valuation does not need the economy to grow 2 percentage points more than what the consensus already has, kind of thing. No, so if you think about sectors like the one you've just mentioned, artificial intelligence, everything that has to do with security and defense, everything that has to do with the improvement of services in healthcare, those businesses don't need the cycle to move one way or the other, because they move in a different aspect, which is the one of added value. What we, you were mentioning your experience in business, but that is critical. Is what you're looking for ultimately is added value, because if what you need is simply that the economy grows a little bit more, or that costs are a little bit lower, then obviously that is something that can help, but certainly does not generate leaders. The leaders are those. I remember, gosh, it's a long time now, but it must be more than 15 years ago, I met Tim Cook. And somebody asked him about if he was concerned about the possibility of hiking rates. Okay, think about that, 15 years ago. And he said, I don't care. And he said, why did he not care at the time? First, because he didn't have debt. Second, because he had products that were of enormous added value. And third, because the demand for those products didn't come from having higher leverage. No, who needs to know whether rate hikes will be high or low? And those businesses that have very little equity. So to me, the key thing, you mentioned how important it is to be liquid in this moment. Critical because working capital kills more companies than the government. And we tend to forget how quickly equity dissolves in a down economy. We don't, we can debate all day, but we all know that when things get turned to the worse in the economy, suddenly businesses that look to be thriving don't even exist, because the equity component of the business was so small and the debt component was so large that it dissolves. Think about all the solar companies that went bankrupt in the 2000s, no? And the same with others, no? Not just because they were solar, it's just because they were 80% debt, 20% equity. If you're 80% debt and 20% equity, and the economy goes down 1%, you're toast. You don't even exist.
Exactly. Thank you so much. I call it a dilution of value, rising costs, and yes, we're getting less output for every input. So the value is diminishing and it's continuing. And, it's important to look at sectors or industries that are more inelastic or essential. You said healthcare, medical, some bios, and all those. And you make a great point, and I agree completely. In one of your videos, and you mentioned how it's not only the financials. When I look at earnings, or I just look at 10Ks or 10Qs, I review them. It's not only it's very important to look at earnings and the cash flow, the free cash flow yield. And I'm always looking at cash, and high debt companies are very concerning right now, especially the ones that are riskier, that involve that constant refinancing to get capital. And with this rate of higher rates, and this environment of higher rates. Also, we look at strategically those that are efficient, streamlining their operations, and vertically and horizontally integrating, because these are opportunistic times where you can seize opportunities and to gain market share, and also to go into new industries and to just grow and diversify. So, and we did that in 2008, and we saw the leaders, we saw the winners emerging. So I love that point that you make as well. and all that. So I want to go into take that point and go into the global markets. And you talk about the emerging markets. It seems the US and Europe may stagnate. So to find these emerging leaders, we may look at other countries. I think you mentioned India, maybe South America. What are your thoughts on that globally?
Yeah. Well, I remember I always say to my students that emerging markets don't emerge. No, they're the same ones that when I was a kid. But that entails it is a joke because obviously the level of growth and the level of improvement and conditions in those countries has been phenomenal in that in this period. Um, what we find is that a lot of emerging economies have stopped growing the way that they should and they could. Mexico, Brazil, these are countries that should be growing 4, 5, 6% in an environment like the one that we're living right now, high demand for commodities, huge supply chain disruptions, etc. Yet they're not. They're actually flat or even in contraction. So I think that the world is growing east side, and that the higher levels of growth are going to come fundamentally from India, from Vietnam, Korea, those countries. Those countries are incredible in terms of, you mentioned the importance of opportunities, no, and how those countries seize opportunities. In the Asian economies that are very adjacent to China, they're looking at the challenges that the Chinese government is bringing with this new and different way of looking at the economy. And they look at the slowdown of China as an immense opportunity to attract business, to attract capital, etc. No? The same way that South Korea did with the stagnation of Japan. So I think that that's where growth is is going to be in the next 5 to 10 years. Unfortunately, Latin America, which is always a big promise, looks to be close to a lost decade, in my view, because I don't know. It's one of those regions that is such a surprise because they've seen the disaster of Venezuela and Argentina, and somehow decided we like the idea. Let's go copy it.
Thank you so much. And you mentioned China, and I guess we do need to touch upon China. And we had issues with the economic restrictions. That was when we first met on the macro space in December. We were talking about that. And now we have other challenges with China. I know we could speak days about China, but could you briefly enlighten us as to what you see going on there and how they may not be so much of a GDP contributor globally as we thought they might be?
Yeah, I think that the Chinese government probably overshot massively in terms of the real estate driver of growth. The real estate bubble is bursting as we speak, and it's an enormous part of the Chinese economy. Real estate directly and indirectly accounts for about 25% of GDP, and the government knows it. The government knows that it's going to continue to weaken, that it is not a driver of GDP growth, and that it certainly should not be, because it reached a level that in which the Chinese economy could have collapsed in a Japanese style stagnation crisis of a decade, of a lost decade, if the government had basically ignored the real estate bubble. But being real estate such an enormous part of the economy, it is impossible to make any other sector offset that impact. So China is going to continue to have sectors that are going to be growing at 12, 15, 17%. Technology, healthcare, services, numerous sectors, but all of them together cannot offset the how could we call it, reallocation or realignment of real estate, which is phenomenal. I mean, think about this. I remember a trip to China, which I wanted to see a phantom city, you know? And I asked the driver to take us to a phantom city, and he said, which? He asked which, because there were fewer.
I guess so.
So the government is aware of this. The government is aware that the provinces have inflated GDP with real estate that is not going to be used in any shape or form, and the government knows that that is likely to mean a 20-30% lower level of growth than what they would have achieved in a different period, and they're fine with it, and probably for the right reasons, to be fairly honest. I think that I mentioned this, and somebody was quite surprised that the burst of the real estate bubble in China is great news for all of us to start with, because it means much lower levels of emissions, much lower levels of consumption of commodities, etc., etc. So you know, it's a China reopening is going to be a positive, but it's not going to be it's not going to lead the economy to grow 7-8%.
Exactly. Thank you so much. Let's talk about alternative asset classes, and mainly commodities, gold. Now, for many years, many didn't even want to touch gold in their portfolios. Now we've seen a surge in gold again. What are your thoughts on gold as maybe a diversification in a portfolio now into the next year or so, especially with stagflation being a possibility?
I think that the way that I look at portfolios, we are long-only investors. We are looking for opportunities all the time. So we're not here to get in and out of the market. By the way, I've never met anybody that is able to do it and do it consistently. So, you know, when the market turns, we look for opportunities, and when the market rises, we look for opportunities to reduce. I think that in any environment, you need to have gold in a portfolio for a very simple reason. It's one of the very few decorrelated assets that exists out there. Right now, I mentioned before that if you look at in a very simplistic way, the market is a huge bet against the US dollar. No? And one of the very few decorrelated assets out there is gold. That's why you always have to have it. Last year, I heard, well, gold didn't work in 2022. It didn't work in dollars. It worked admirably in yen, in pounds, in euro, in pesos, in Argentina, in Turkey, and so no. Gold is working as the way that it should. No, so I think that you have to have a good percentage of gold and precious metals. Not particularly bullish on palladium, but you have to have a bit of that as a cushion, and you need that because, again, usually what happens is that when you have a bad year like 2022 was for bonds and equities, and you have gold and, you know, I call them defenses, huh? It makes you look at the market in a more benign way for opportunities, which is ultimately what we are all looking for.
Thank you so much. I agree completely. I am a proponent of having, you know, not a large proportion, but, you know, definitely in the portfolio, gold.
Yeah.
You know, you mentioned right now, you know, we have bonds going up, equities going up, and that's not really what we want to see. So
yeah.
Could you talk about bonds? Are you bullish on bonds at this point this year, at any point, or in the future? I always, in my opinion, when I look at bonds, I think the best time to buy bonds is when we have that reversal in rates, when we actually see that. Do you see opportunity at some point? If you could just discuss that, it would be great. Thank you.
I don't like sovereign bonds. I don't see the reason to own sovereign bonds. Sovereign bonds are a tax, and I'm already taxed in my income, in my wealth, indirect taxes everywhere. So I'm not interested in sovereign bonds, and I think that they're monstrously expensive anyhow. But I do think that there's opportunities in investment grade bonds, and particularly in commercial paper of some of the issuers that are showing very resilient earnings and very resilient cash flow generation. So, again, one of the problems of a very correlated market is that we talk equities and bonds, and I think that we have to be very much look in detail about the issuers, but I think that investment grade looks okay to me at these levels. I don't like sovereign bonds, and I think that the high yield part of the bond sector is also quite dangerous because of what we mentioned before, because the diminishing ability to repay the debt. So I prefer to be on that front. In terms of equities, I think that, I don't like a market that is so heavily correlated to start with. And I think that we agree on that. Is that when everything goes up for no reason, and everything goes down for no reason, it may go down again for no reason, and it makes me very, very nervous. I would have actually, I think that it would have been a very healthy signal if there were diverse performances in the bond spectrum in this first months of the year, but it hasn't happened.
Agree completely. I like commercial paper as well, with money criteria, of course, but agree on that. A lot of people like to say history, and this time, I guess they like to say this time is the same, and that the S&P cannot have two negative years back to back. Do you think that this time will be different regarding that, and we could have two negative years back to back?
Oof, that's of course you can. Of course you can, because we have to remember that we come from very strange times in which we had the S&P 500 reach all-time highs in the middle of a pandemic, no? In which earnings were collapsing, actually, not just falling, but collapsing. So it may happen because we come from a very strange and a very unusual period, 2019, 2022. What I do think is that it's going to be a very volatile year, and I get the impression that it's very likely that we will see almost 100% of all the returns that we will make out of the market in the first 3 months.
Wow, thank you so much for that. Daniel, it has been the utmost pleasure to be speaking with you today, a global macroeconomist. You are amazing. I'm definitely going to check out your books. And could you just tell us how everyone can stay in touch with you and learn more from you? Because you really simplify complex economics for all.
Thank you so much, Wolf. It's been an absolute pleasure. I've thoroughly enjoyed it. Time has gone so quickly. The way to find me, it's quite easy, actually. It's probably easier to find me than to not find me. You can find me on Twitter at Lacalle _IA. You can find me on YouTube. I have 2 channels, one in Spanish, one in English, and you can find me on my website, which is www.dlacalle.com/en. So, not difficult to find. You look for Daniel Lacalle and you'll probably see me somewhere.
Thank you so much. And thank you everyone for joining us today. And until next time, take care and have a wonderful, wonderful day. Thank you for listening to the Rose Show podcast. Please visit RosannaPrestia.com for more episodes. See you soon.